Hey, this is Danielle, and today I'm going to be managing my NVDA butterflies that I put on over the earnings report. So here is an image of what NVIDIA is doing after earnings. NVIDIA is up 83 points, which is going to be 12%, and we've traded pretty much directly into a Fibonacci target zone around 766, and the next target is going to be up here at 794, which is going to be pretty much 800. Anytime you're that close to a key psychological value, you definitely want to use the key round number, which is going to be 800. Really nice pullback into the 21 EMA. We've also basically negated the sell signal that we had on the weekly chart from yesterday. But to keep a long story short, basically, I traded this one really small for earnings, and it's not working out great. It's working out okay, but I wanted to go ahead and show you an example of, what happens when you put a butterfly on both sides, and then also what happens when you have the stock actually blow through one side of your butterfly. So first of all, I traded this both ways. I placed a butterfly, one of them at 750. I felt like 750 was going to be a pretty good target because yesterday, the expected move, actually, let me see what it was. Okay, so I think the expected move was like $66, and NVIDIA is up $90. So anytime you have something that's up, about 1.5 times the expected move, that is going to be a moment in time where it's likely going to keep going. It's not quite at that value, but it's pretty dang close to where, once it's up 1.5 times, like it's going to probably keep going. So let's look at my butterflies. I had two butterflies on. This is the one that I'm mentioning where I was targeting $750. So if you can see, right now we're at 761. That means that the center strike on my butterfly is at 750, and it means it's in the money by about $11. Now, when that happens, you can see that the center strike of the butterfly is going for about $21. Well, that's not what you want in a butterfly. In a butterfly, you are selling that center strike, and ideally, you don't want the price of the stock to go through that center strike. You're trying to create a range. In my case, I made it from about 730 to 750, where this is basically your range where you can really profit if the stock comes up into that zone. The reason why I picked that range was because 730 was enough out of the money where I could get the trade really cheap. I only spent $1, which is $100. Um, and I just wanted to make a small lotto trade on this. I mean, I could have made the range wider. I could have spent more money. I could have put it higher, but this is what I did. And I did this because the high open interest strike is at 750, and because it was within range of the expected move over the earnings report. So anyways, I was targeting 750. Now, what's happening here is those strikes, this is what they looked like. This 730 call was originally $13.47. The reason why I did a butterfly instead of just buying the call is because who wants to buy a call for $1,300 when you could make a spread and pay $100? So that's what I did. That call is going for $35 now. The ones that I sold were going for $9.92. Now with the butterfly, what you want is you want the ticker to trade upwards and, come close to that center strike, but not go over. And, ideally sit around here so that those calls can decay. You want those calls to go down in value. Now, in this case, because we're through that strike, they're not going down in value. They're going up in value. So they were sold for $9.92. They're going for $21. So that's why this butterfly could be, well, if it was underneath 750, it could be worth a lot more money, but it's not because it's through the center strike. So what happens? Well, as you can see, this butterfly is actually still making me money. Um, I paid $1. It's going for $3.32. I'm making $223. Not, now it's going for, see, you see how the price is going to move around quite a lot. Now, when you try to close it, you want to make sure you can get the best fill. So if it's going to go for, let's see if I can get out of it for 460. Da-da-da. So with earnings trades, they're going to be moving around a lot, especially with something like NVDA that's kind of going crazy after the earnings report. So if you can see that your price is moving, you know, by a pretty big variance, it's going from, being worth $5 to being worth a lot less. You basically you want to get out of this trade because there's nothing good that can happen when it keeps going through the center strike. It's fine if it goes through it a little bit, but once it goes, all the way to the other side of the fly, this $5 is going to disappear and your $1 will disappear as well. And the dollar you spent is going to go basically to zero and you're going to be at a loss. So right now, yes, it is through my center strike quite a bit, but if I can manage to work this order and actually get out of this trade, um, and take it off, for a profit, that would be fantastic because, well, it's likely that it'll go to a loss, especially if this thing keeps exploding. So with the butterfly, you can see that there's a pretty big range here as I'm trying to get out. Obviously, I'm trying to sell it for as much as I can. So if I can see that the market price is around $5 and, sure, I could sell it for 3 if I really wanted to get out, and I might have to do that if it won't get filled. But trying to close it around the top end of the range is going to make me, more money. So ideally, that's what I'm going to do. Now, there's a problem here, which is this is a 1.5 times the expected move, so it's just exploding. So ultimately, I don't want to be a dick for a tick, and I don't want to, demand my 470 price point, especially if this is going to keep going lower. So I haven't gotten filled yet, so I'm going to go ahead and unlock it. Okay, let's try 412. Okay, I'm out for 445, so that's fine. I'll take it. Got in for 1. I'll get out for 445. That's fine. Now, I didn't actually make that much money, and I'll tell you why. I didn't make that much money because I had this trade on both sides. So I had placed a put butterfly as well as kind of a hedge. I had thought, well, just this is crazy. This move has been completely parabolic. I just felt like what are the chances that it's actually going to continue higher? It's more likely that it falls down into 600, just because if it doesn't have a huge blowout report, then there's no way that it's going to be able to continue higher. So I wanted to have a hedge on as well. People ask me this all the time. They say, hey, you know, are you hedging that trade? And the thing about a hedge is that when you have a trade on both ways, one of them is going to lose money. So, my hedge trade, I did a 620, 600, 580 put fly. That is a complete loser. I lost $168 on that side because you can't win on both sides, right? So what happens is I could have made a 4x on my bullish fly. But and I did make a 4x on the bullish fly, but the thing is that you have to account for the money that you're losing on the bearish fly. So you have to subtract that $169 from the money that I made. So I only made $182. Is that a great trade? Not really. The reason why it wasn't great was because it blew through the center strike so much. I actually think I want another piece of this though. I think I want to trade this up into 800. So let me see if I can do one more. All right, so let me see if I can do 775, 800, 825. So I'm going to put another $4 on this. Oh, actually, I don't know if I can do this because I got assigned on my. Okay, never mind. Yeah, I can. So I'm gonna make another, but I'm gonna make another video because I got assigned on Palo Alto yesterday, and I'm gonna have to manage that assignment. Sometimes they won't let you enter new trades if you got assigned, but I could, so that's great. All right, so now I entered another trade. The next trade that I entered is just basically an out of the money butterfly. It's targeting $800 a share in NVDA. That's because this thing is just on fire. We have a lot of high volume and momentum buying after the earnings report. Probably could have gotten into it like 15 minutes ago for a better entry. Right now, 6:49 a.m. Pacific time, so the market just opened 20 minutes ago. Generally, after the first 15-minute range is where you can see, if you have a first 15-minute candle and you're breaking out, that is generally where you're going to be able to see that it's still going. In this case, you want to see a breakout up above 775 because that is going to be the overnight high. So a break through that zone is where we're going to basically know it's going to keep going. But overall, when you have a move like this, 1.5 times the expected move over an earnings report, that is going to be your signal that it's going to keep going. Now, when you're looking at the options chain and you can see that there's a ton of open interest here at the 800 strike, I don't know. I just can't not do it. So now I have another butterfly, 775, 800, 825. Basically, what I did was I just placed that just directly out of the money. So I bought the 775 strike when NVIDIA was just below that value. And the goal is to spend, less than $500 so that I can trade NVIDIA from 775 to 800. Now, same situation that I'm going to get into. If we get up to 800 and go through it, I'm going to want to take it off because the butterfly will start eventually losing money. You don't need to take it off at like 799.99 because you'll make money through this range, but you do want to take it off as close as you can to this value without it going over. And today is Thursday anyway. This is going to expire tomorrow, so I got to take it off either today or tomorrow, one of the two. But that is how I traded NVIDIA. Didn't really make too much money on this trade because of, like I said, the hedge and because it went through my center strike a little bit. But I wanted to make this video for you about how I'm managing butterflies, and we will see how this 800 fly goes. Thank you very much. If you want more videos like this, make sure you subscribe, and I'll see you in the next one.